Cash holds a debt instrument which it purchased during the year at its cost of 20 million. When the asset was acquired, the credit risk was low. It has been assessed that there is a 0.5% chance in the next 12 months there will be a default. In the event of default, it is estimated that 30% of the value will be lost. Right, time out for a second. How much money are we owed? 20 million. There is always a risk of default. Now the judgment here is that there is a 0.5% risk. Yeah? That there is a 1 in 200 chance that this company is not going to pay us back. So there is a 0.5% chance of a default. If the company doesn't pay us back, it'll go into liquidation, and actually we wouldn't lose everything, we'd only lose 30%. So there's a 0.5% chance that we will lose 30,000. Sorry, there's a 0.5% chance we will lose 30%. 20 million at 0.5% at 30% gives me 30,000. You're therefore effectively saying that your recoverable amount is 19 whatever. You'd continue to use amortized cost on this amount. So you would be debiting your profit and loss account. This is an expense of 30. And you'd be crediting an allowance. You'd be crediting an allowance, of 30. That would effectively be what you would be doing.
One question that comes to mind. The debts are normally secured, right?
Yes.
So how come this makes sense? Why are we providing when our debt is secured?
Okay, so they're going into default, and when they're going into default, we're not losing all of the money, presumably because there is some security. So if perhaps the debt was unsecured, it would then be 0.5% of 100%. You might be losing everything. But if the debt was secured, there might be a judgment which says 30%. Or there might be a range of judgments. There might be 2 or 3 different outcomes, and you would take the weighted average of those outcomes. Yeah? Now, the point I would like to make is this. It's really easy. If somebody says it's 20 million, it's 0.5%, it's 30%. You just multiply the figures together. It's really easy. Alright? But where does 0.5% come from? How do we know that we will lose 30%? That's a judgment issue. When the UK voted to leave Europe, when the UK voted for Brexit, the UK's credit rating, the government, the countries, the UK's bonds, suffered a change in value because there was a greater risk of default. The market moved it from a AAA to a AA or whatever it was. So there was so somebody is out there saying, I wonder what the risk is that the British government will go bust. I wonder what the risk, because they are borrowing money and we have to assess the risk. Now that's not my job as an accountant, but it is my job to understand that if there is a risk of default, we should anticipate that risk. There has been no default by the British government. But if you hold UK bonds, then you're holding a financial asset, which is an amortized cost, and when the risk goes up, you've got to say to yourself, well, it's now 0.6%, or whatever. All right? So I repeat. Give me a number, I'll debit and credit. Give me a number, it's easy. But where does the number come from? Now in the exam, the number's in the question. Yeah? So there may be a commentary, there may be an observation that this number is subjective because we're doing an anticipation of the risks that we think might happen. So that's a judgmental issue, that's a subjective issue. We're taking into account future information, we're anticipating losses, we're writing assets down, we're being prudent, but we're playing with numbers. This is not a cash flow. In the cash flow statement, when we do the indirect method, this will be added back because it's just an impairment loss. Blah, blah. Blah, 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 blah. I mean, on the paper, you just got a number, but I hope in your head, you're appreciating what I meant when I said it was a subjective process. Can you do the second one?